Oakmark portfolio manager Mike Nicholas joins us now to discuss. Mike, let's start off with KKR. You know, I don't talk about it too often. A lot of people think of it still as a private equity firm, but it's a lot more than that, and a $50 billion market value. Why is it a big part of your portfolio?
Yeah, thanks for having me. You know, KKR is one of the world's largest alternative asset managers, and they do have really strong positions in some of the faster growing pockets of the market, like infrastructure investing. You know, if you kind of step back a little bit, alternatives have been taking share of invested assets for quite some time, and KKR is taking share within alternatives. We think the company is extremely well managed and has a really attractive long-term earnings growth outlook. You know, the earnings of the business have doubled over the past 4 years, and, you know, we think they can double again, or management thinks close, over the next 4 years. I think what's interesting is that a more nuanced analysis of the valuation can reveal what we think is an even more attractive opportunity than the headlines would suggest. You know, KKR has significant investments on balance sheet within their own funds today that currently account for something like $18 a share, almost 30% of the market cap. So that's an unusually high percentage relative to peers. So if you adjust for the balance sheet investments that I mentioned, we're paying a really low double-digit multiple for what we think is a strong franchise capable of growing earnings double digits for quite some time.
Yeah, it's always interesting, you know, why not a Blackstone or an Apollo or even an Ares or a Carlyle? Why is KKR amongst the alternative asset managers the one that you've chosen as opposed to some of those other names?
You know, we think KKR extremely well managed. It's been growing quite a bit faster than Blackstone, and we think it trades at a lower multiple adjusted for some of the balance sheet investments. So we think you kind of get the best of both, where we favor kind of the outlook for earnings growth there, and we think the valuation is cheaper.
All right, last time you joined us, which was back, I believe, in October, you actually gave some good advice to our viewers. You were touting Willis Towers Watson and Fiserv, both of which were up sharply in the period since then. So well done. You still like those names, or have they moved enough where Oakmark might look to take some profits?
No, we still like the names. You know, we run a very opportunistic portfolio where we're always looking to allocate, our dollars into the highest risk-adjusted returns we can find. But no, in both instances, we believe the companies are kind of executing according to our expectations, our fundamental expectations, and think they look quite cheap. You know, in the case of Fiserv, it's probably trading at, 13 or 14 times next year's earnings, which we think for a business that's capable of growing mid to high single digits with pretty consistent margin expansion over time, that's a pretty cheap multiple, certainly lower than a market multiple today. And Willis, somewhat similar, where we think that the gap between its peers is still quite wide. So we think there's a lot of opportunity in both.
Hey, Mike, we had Bill on set a few weeks ago. We talked about Alphabet at the time. When I think Oakmark, I think Alphabet to a large degree. And we were thinking ahead about whatever AI options they might have. Then since then, obviously, it's been a whirlwind of news from Microsoft and Alphabet. What's your sense about their response and whether they can come back from this recent loss of market cap?
Yeah, it's a good question. We certainly think that Alphabet has the resources to be able to respond here. They've been investing very, very heavily in AI for years to improve search results and the ranking algorithms. And they spend $40 billion a year in R&D. They've also been investing very heavily in their own, language processing capabilities. And, we think the combination of the technical and the brand and the distribution advantages that they have that have enabled them to have 90% market share in search for the last 15 years puts them in a good position to respond. I think, the second part of the question is really, what are we paying for the business here? And as we look at the valuation today, the stock is selling, about as low of a PE multiple relative to the S&P since it's been public. And as you know, as we kind of think about some of the under-earning or non-earning assets that they have within the company, we think we're paying even a significantly lower multiple than that. So we still like the risk-reward. It remains a material position at Oakmark.